Based upon what we just heard momentarily, let's be more concrete now and examine the cornerstone of the banking regulation framework. Basel III. Basel III is an international regulatory framework developed by the Basel Committee on Banking Supervision. It introduces reforms to strengthen regulation, supervision, and risk management within the banking sector. Basel III consists of 3 pillars, each addressing a specific aspect of banking regulation and risk management. Let's start with Pillar 1, minimum capital requirements. What is the objective? Pillar 1 establishes the minimum capital requirements that banks are required to maintain to cover credit and market risks, among others. The primary goal is to ensure that banks have a sufficient capital buffer to absorb losses and maintain financial stability. The main focus is on the following risk categories, respectively. Pillar 1 classifies risks into 3 main categories, each associated with a specific capital charge. We are already familiarized with credit risk. These are capital requirements for potential losses from defaults on loans and other credit exposures. Furthermore, market risk. Capital requirement for potential losses arising from changes in market prices, including interest rates, foreign exchange rates, and equities, as we heard in the previous sections. An extra emphasis is on operational risk, which is not a focus topic in this course, but worth pointing out here once more, and hence more it reflects the capital requirement for potential losses resulting from inadequate internal processes, systems, human errors, and external events. In Pillar 1, detailed instructions are given for the calculation of capital requirements. The capital requirement is calculated based on percentage of the risk-weighted assets or RWAs of the bank. More about that in the upcoming learning element, where we will walk through an example in more depth. On top of that, the minimum capital ratios are determined. Basel III sets minimum capital ratios that banks must maintain, including the so-called minimum total capital ratio and minimum Tier 1 capital ratio. We already mentioned that in the previous video, if you remember. Let's move on now to Pillar 2. Supervisory review process, or so-called SREP. What is the objective? Pillar 2 focuses on the supervisory review process and aims to ensure that banks have adequate capital to cover risks not adequately addressed by Pillar 1. It involves a qualitative assessment by regulators. What is the supervisory review and evaluation process about? Regulators, as part of the SREP, assess a bank's internal risk management practices, capital adequacy, and overall financial health. This involves evaluating the bank's risk profile, risk management processes, and capital planning. What does this assessment entail? The additional capital requirements. Based on the SREP assessment, regulators may require a bank to hold additional capital, or so-called Pillar 2 capital, to cover risks not adequately captured by Pillar 1. This additional capital is specific to the individual bank's risk profile. Alright then, this brings us to Pillar 3, market discipline. What is the objective here? Pillar 3 aims to promote market discipline by requiring banks to enhance transparency and disclose relevant information about their risk profile, capital adequacy, and risk management practices. Market discipline is reflected by the disclosure requirements. Banks are required to disclose information on their risk exposure, risk management processes, capital adequacy, and other key aspects. This information allows market participants, investors, and other stakeholders to make informed decisions. Accordingly, what are the market discipline incentives? By providing information to the market, Pillar 3 encourages market discipline. Investors and stakeholders can assess a bank's risk profile and financial health, contributing to more informed decision making. In summary, the 3 pillars of Basel III collectively provide a comprehensive framework for regulating and supervising banks, ensuring that they maintain adequate capital to cover various risks, enhancing supervisory review processes, and promoting transparency and market discipline.